Good morning. Morning here anyway, and it is the 14th day of September. This year has flown by, most certainly. I wanted to meet with you and have a few minutes to talk about the markets just in general and some thoughts that I have. So let's just jump right in here. As we look at the world as it exists, there's a lot of crazy stuff going on. And by that, I mean a lot of things in our environment that we really haven't dealt with as much in the past. Now, I'm not saying not entirely, but there's a lot of things happening in here. So let's talk a little bit about, for example, the stock market in general. I use the Standard & Poor's 500 as a good proxy for what I call the stock market. That's probably arguably some of the best stocks in the world, 500, market weighted. So it gets heavily weighted to what's happening as far as market cap, meaning that the bigger names get the bigger weighting. So, but at the end of the day, at least we have a good view of what's happening with that particular group of companies. Now, these are all United States companies, and you can see looking at year-to-date numbers, what's not to like about that. Now, if you think about this a little bit, the other side of this is, what are these companies' earnings? Well, guess what? Pretty good. Earnings are pretty good. And then the other part of it is, does it become more difficult to buy these shares as this continues to go up? And so the answer, of course, is yes. It's harder to find a bargain in there, just like real estate, sort of the same world right now. So when you look at stocks and real estate, guess what? Those particular two things are inflating because that's where money goes to try to find something that will go value. So right now, the trend is your friend. Really shouldn't fight that. Now, I will say that in here, by far, large growth stocks are the soup du jour. This is what's happening in here, is the big growth names. You know, when you look at, you know, oil type stocks, Exxon, things like that, not so hot. I mean, okay, but not so hot. When you look at, you know, companies like Caterpillar, a little different, you know, but still nothing like the trend of Microsoft, which is tech, which is getting the lion's share of the attention here for the past year or two. These companies have grown to massive sizes. Their market cap in many cases are over $2 billion. So then, let's see if I can do this. Most everything else, small cap as an example, those are the smaller companies, mostly US, and you know, that's fighting to find an upward trend. We really haven't been up since, you know, right in here, which was February. You know, the mid-sized companies, a similar story, but a little better, but at the end of the day, more sideways. When we look at our friends overseas, so I will choose an index. I use iShares here as my proxy, but this is the emerging markets ETF, which encompasses China and the Latin and the Indias and all that sort of stuff, the emerging countries that have been defined in this index. And again, what you're seeing is different than looking at the S&P 500. If we do a comparison, just to have a conversation, the S&P, in Craig vernacular, is smoking the emerging markets. So you can see that the U.S. economy is getting the lion's share of the money right now. So is that good? Yeah, I mean, that's good for us over the short run. How about Europe, Australia, Far East? So that would be, Far East would be countries like Japan that are developed countries. Not bad, you know, doing pretty good. But in every case, I'm seeing is the countries that are printing money, creating quote unquote stimulus, seem to be appreciating. So is that what we have to do? Just create a lot of currency inside of our economic system in order to have growth? And the answer is apparently so. I mean, you can't argue it. When you look, for example, some other things, let's see if I can drag and drop this over and make sure that we see this here. Hang on just a moment here. Let me make sure I have this right. Okay, that's what I want. Sorry. So when we look, for example, at some of the things in here, and I just made some screenshots of things, the S&P 500, the dividend yield, because the price is so high, the yield on these stocks, price versus payout, is very low. When you look at inflation, to me, and I just listened to an interview with Kathy Woods this morning, actually, and she's saying that once all the dust settles and all our supply chain issues are fixed up, that she actually thinks we're going into deflation. I'm not sure, I'm just going to say here's what I think or not, but you can see currently back in the day when we had high inflation, then we've had fairly low inflation, and now inflation at least has spiked up a little bit more than what normal ranges have been since really the early 90s. So gross domestic product, when you look at GDP, you see that this thing really runs in the 2 to 3 range for a long time. Here's 95, here's 2000, and you can see that after a decline, some sort of economic event, GDP suffers, and then it does better, and then it suffers again after, obviously market declines. But this last one has been off the charts. Our GDP was slammed to the bottom because people were sent home from work, don't come to work, work from home. And then the reverse has happened, since people went back to work. That's not an economic recovery. That's just a very unusual event. You might die from a virus, don't come to work, go back to work. So we will see what the normal economy looks like sometime in the future once people are normally going to work in that type of thing. But right now it's a little weird to see. And then lastly, when you look at money creation, there's been a lot of money printed. There's been a lot of money injected into our economic system. And this is in millions, so just understand, a lot going on right here, right now. So there's no yield, there's a shortage of yield, and people are going to where they are treated the best. And right now, those are things like real estate. I mean, real estate right now is rocking the house. If you are a seller in real estate, guess what? You're pretty happy because you are getting premium price. It's a seller's market, all that sort of stuff. Here's what the year looks like so much in the real estate index. So this is mostly REITs, R-E-I-T-S, real estate investment trust. But at first glance, you can see we have periods of up. They'll sort of correct a little bit, up correct, up correct, up correct, and we're in correction right now. Probably we will see this continue on its uptrend. This is a 50-day moving average. This is a 200-day moving average. There's a big disparity in these two right now. So what you should glean from this is prices are pretty high. This is this year. All right, if you add 2 years to that, now you get to see reality. So that's what happened during the COVID hit. Recovery was about right here, which is what, end of April, 1st of May, something like that. And now we're seeing some new highs. So just for perspective. Gold, everybody, not everybody, but a lot of people say, should I be buying gold? And I'm like, I can't see a reason to buy it. Gold is a green piece of metal. It doesn't really produce anything. It doesn't really have any yield. It can't earn anything. But, a lot of people see it as a currency surrogate. So, okay, I can see the reason why sometimes people would buy it. But again, it's a commodity that you should buy and sell as far as I'm concerned, unless you feel like it's going to collapse and you need an alternative currency to the US dollar, which brings you to Bitcoin, which is amazing. I'm going to use the Grayscale Bitcoin Trust, and you can see Bitcoin just chugging and plugging through late 19, early 20, and then going ballistic, I guess, or it went up a whole lot, dropped like a stone, and now it's trying to find its way right in here in this range. Fascinating. But again, this is another alternative currency. This one has more traction than gold, in my opinion. People are very much interested in this one versus gold. I mean, gold's not gone. It's just this is the new currency surrogate that a lot of people are looking towards. How about our bond market? This is a 2-year look, so you can see that a lot of the money that has been printed has gone to support the bond market. With yields for long-term bonds less than 2%, high-quality bonds, most of them, then you've got to kind of think for yourself and say, guess what? Bonds are really not the safe haven that they used to be. If they raise rates, these bond prices will drop because there's an inverse relationship between bond prices and bond yields. And with yields so low, maybe a little bit lower they could go, but with yields so low, it's going to be difficult to justify owning these things, thinking that they will protect you if we get some sort of economic event. Who knows? I'm in the club that says when things go down, you sell them. You don't take the big hits. Have to have a point in time where you would sell, but that's not the conversation of the day. So anyway, inflation is creeping up. Who's kidding? Things cost more. Go to a restaurant, go to the gas station, those types of things. And then so are we really any better off if things cost more? There's a lot of money in the economic system, and we're somewhere along the line of trying to get recovery in our economy. It's a weird time. So just keep your antenna up and make sure that if things get a little weird, that you have an exit plan. But right now, stay with the trend and understand that stocks are where you should be for more of your money, and then the protection comes in deciding when to sell. That's all I have for today. I hope that I helped some. If not, I'm sorry. And I hope you make it a great rest of the month.